Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking silver, the volatility in that market. We're also going to be recapping some of the commitment of traders reports for a number of different metals, as well as I'm curious in terms of a short squeeze. So we've heard a lot about it in silver or even in copper. We're chatting with Jeff Christian, managing partner at the CPM Group. Jeff, first, let's talk about silver. It's been quite volatile here. It broke above that $30 level, and we're seeing almost day after day of kind of this back and forth, close to $1 moves just each day. That's high percentage. The price isn't really going anywhere. It's holding kind of right between that $30 to $32 level, but there's a lot of volatility. What's causing this volatility, Jeff?
I think you're seeing it in silver, but you're seeing it across commodities and other financial markets, even stocks and bonds. You're seeing increased volatility. And I think what it really reflects is the investors are trying to come to terms with what's going on in the economic and political environment. And there's a lot of uncertainty. And investors say, okay, well, we're seeing stronger economic data that suggests that interest rates will stay higher. So gold, precious metals probably will fall. And there's a selling primarily in the futures and options market, primarily in the futures market, it seems. And then they'll say, okay, but those higher numbers will lower inflation, which will allow the Fed to lower rates, which will cause silver to spike. So you see the spike up. And I think that you've seen, well, since March, you've seen increased volatility in silver on an upward movement. We saw prices relatively flat in January and February, $22 to $24. And then they spiked up and they spent March between $24 and $26. And then they spiked up at the beginning of April and they spent most of April like between $26, $27 and $29. And then they spiked up again at the beginning of May, and really through the first 3 weeks of May and got up to $32.70 something, almost to $33, and then they come back off. And they've been bouncing around between, say, $30 and $32.50 ever since. And I think that reflects investors saying, okay, I'm sort of bullish on silver, but I've got a lot of questions about what's really going to be happening in the economy and what's really going to be driving silver prices. So I think that's what you're seeing with the volatility.
Well, Jeff, just to that point about what's going to be driving silver prices, some people have just made the case that it's merely technical momentum. You've made the point many times on the show that a lot of times it's investor demand that moves the price at the margins. But we always hear that silver is a hybrid metal. It's part precious metal, part industrial. So a lot of people are pointing to manufacturing and the different drivers for the industrial side. Out of all those, the technical side, the industrial side, or the precious metals movement with gold, which one do you think is actually driving the prices higher right now, and which one will continue to drive the prices higher in silver?
Actually, I think it's a combination of all three of them, and I'm not sure which has the greater weighting. Possibly the technical factors or the investment demand factor. You've got investors interested in silver. A lot of them are technically driven. The technical charts suggest higher prices. Industrial demand, fabrication demand is in there. It's been relatively strong, especially in electronics and solar panels. It hasn't been nearly as strong as the silver promoters say, but it has been strong in 2023. It's a little bit less dynamic in 2024, but the increase in fabrication demand has tightened the balance between newly refined silver entering the market and fabrication demand. There's a lot less metal that's newly refined coming into the market to meet investment demand at a very time when some investors are starting to buy silver again. We went through a situation really for much of 21, 22, and 23 where investors they entered 2021 very bullish on a bunch of nonsense, silver squeeze and Wall Street silver, just absolute garbage information. And investors raced into silver and they drove the price up to $28, $30. And then over the course of the last half of 2021 and then 2022 and 2023, there was this investor disillusion that set in. And the price went from $30 in the beginning of 21. It got down to $17 in the middle of 2022. It came back up, but it spent most of 2023 between $20 and $26. And there were any number of investors who said, I thought it was going to 700 or 50 or 100 or 5,000, listening to some of those promoters on the internet. And there was a lot of disillusion, and there was a lot of silver being sold by investors. That's changed over the last 2.5 months, really, since March. You saw that disillusionment in January and February when the price was trading between 22, 24. But once the price started rising, some investors said, okay, well, maybe this is the time to start buying. And the price got up to 30, 32, 33. And if you ask, well, okay, it got to 33, why didn't it go to 50? Well, because of basic economics in the silver market, but also any number of people who had bought it at 28 or 30 or $32 in the first quarter of 2021 saying, I'm going to get rid of this stuff because I've been waiting for 3 years for an opportunity to make myself whole on this. And that, if you look at the commentary on a lot of the silver YouTube videos, people saying silver's been my worst investment. I'm so sorry that I ever bought it. There's been a lot of disillusionment, and the silver market hasn't really stepped up and said, listen, let's have a rational discussion about an honest supply-demand outlook and give investors a substantive, credible explanation as to why silver prices have behaved the way they've behaved. And in that kind of environment, a lot of investors are saying, I'm just out of here.
Yeah, that's what happens in those markets, right? When a market has struggled that much and so many other markets have done well. But Jeff, I guess big picture, is silver going to $50? Now that we're over 30, that magical at least $50 number. Do you see it happening?
I have said repeatedly that silver can spike to $50. It can't stay there. The fundamental economics of silver supply and demand, physical silver supply and demand, prohibit the price of silver staying at $50 for a long period of time. It can spike up there for 5 minutes the way it did in 1980. It can spike up there for 20 minutes the way it did in April of 2011. But it can't spike up there and stay because there's so much silver supply, above ground refined metal, and in-ground refinable. And also, silver is an industrial metal. And at $50, you would see severe cutbacks and reductions in per unit use of silver in any number of electronic applications and in other applications. Copper is actually usable instead of silver in some applications. People don't realize that. You had this meme a few months ago about how the Manhattan Project used a whole bunch of silver from the Treasury stockpile that it needed for magnets when it was trying to develop the atom bomb. The reality is that the Manhattan Project wanted to use copper, and the U.S. government said, hey, we're at war with Germany and Japan. We can't spare any copper, but Treasury has 3 billion ounces of silver sitting in its warehouses. Use that instead of the copper. So it wasn't that they needed silver for their magnets for the Manhattan Project. It was they couldn't get copper, so they substituted silver. Fast forward 100 years, and now you can sit there and say, okay, if we can't get the silver, we can substitute copper in any number of applications. Not in all applications, but in some of them. So if you got silver prices rising over, say, $36 an ounce on a sustained basis, you would see substitution in fabrication demand. You would see investors who had bought this stuff and held it for a long period of time saying, okay, I don't see it going to 50. Let's be realistic. I'm going to sell it now. So you have above ground inventories, you have cutbacks in fabrication demand, and you have increases in mine production. So silver can't go to 50 on a sustained basis. If you know anything about silver's fundamentals, physics, mining, fabrication demand, electricity, you can understand that. You have to be a true believer to think otherwise. But the rational expectation is that, yeah, the price of silver is high. We're seeing strong demand from fabricators. we're seeing some investors starting to re-enter the market, and we're seeing other investors who have been selling for 2.5 years reducing their sales.
Well, Jeff, let's also dig into what you're seeing on the commitment of traders reports. We had an interesting discussion before we started recording today that often in the market, you'll hear people present the commercials as the smart money and the speculative investment demand from hedge funds and speculators as the dumb money. But you made a great point that really the commercials are the market makers and that the reaction from the COT is really just an inverse reaction to investment demand. So I'd love you to unpack that idea and then just what you're seeing on the COT reports.
Yeah, I was being a little bit oversimplistic, but yes, the commercials, generally speaking, are a mirror image of the non-commercial positions on any futures market. And that's because if you want to go long or short a futures contract, someone has to sell it or buy it from you. So if investors want to go long silver, that means that commercial entities have to go short. They're market makers. They're standing there waiting for somebody to come in as a buyer or a silver of a silver futures contract. If they're a buyer, if the investors come in as buyers, then the commercials are selling those futures contracts to the investors. And if you look at the commitment of traders reports, we have them going back to 1996. We actually have them going back further, but there was a change in the way the commitments of trader reports was made in 1995, 1996. So the data prior to 1996 is not necessarily comparable to post-96. But we have in our Precious Metals Advisory Monthly Report, we have commitment of traders reports, charts, and tables for commercials and non-commercials. And you can see the non-commercials, the investors have been net long silver for almost the entire time since 1996. There have been very few times when investors have actually gone net short. And then you can compare that to the commercials who have been net short almost the entire period of time. And the only time that the commercials went net long was around 2018, 2019, when, lo and behold, the non-commercial investors went short. So the commercials data on the COMEX mostly reflects the commercials being market makers providing liquidity to the investors who want to be long. Now, there's additional commercial activity that shows up there because the commercials, many commercials are also involved in the physical market. A lot of commercials own, if you're a bullion bank, there aren't too many bullion banks and traders that lease metal out anymore to fabricators. There used to be 3 or 4 times as many banks that would own gold and silver, as well as platinum, palladium, and copper and other metals, and they would lease them to fabricators. A lot of banks have gotten out of that business, but there's still a handful of banks that do that. Those banks own that metal, and they lease it to fabricators on a rolling basis. They hedge their price exposure by shorting futures. So part of the commercial short position is actually a hedge of a long physical position that those commercials have for a variety of commercial bases that they do. They provide, they're buying forward from mining companies. They're providing liquidity to smelters and refiners. They are leasing metal to fabricators and semi-fabricated product manufacturers. So there's a whole range of services that they have that involve owning inventories and hedging those inventories' price exposure wherever they can, either in the forward market or the OTC options market. Some of them actually will from time to time use silver to hedge their positions, but if they can't find the liquidity in the forward market or the OTC option market, they'll go to the COMEX futures and futures options markets to hedge their long physical positions with short positions. So those commercials, it's not that they're smart, it's that they're market makers. They may be smart, they may be smarter than most investors who are sitting around waiting for $500 silver, but it's not that they're smart money and the investors are dumb money. It's that the investors want to be long silver and the commercials are market makers.
Two sides to the trade then. Hey, Jeff, someone's got to take that trade if people want to go long. What about open interest though? One, what changes have we seen? Have we seen open interest increase, and how do you use open interest to gauge interest or growth in the market?
I haven't paid too much attention to open interest lately, but we do pay attention to it. And it's very important, and it's mostly important. Most of the open interest is in the nearby active and the second nearby active contract. So right now, that would be the July silver futures contract and then the September contract. And one of the things that you saw was open interest roll out of the May contract into the July contract. And the July contract right now has a lot of open interest, which suggests to us that the price of silver could rise briefly, sharply in the second half of June, as those companies that have that open interest in the July contract say, okay, we don't want to deliver into that, and we don't want to just close out the accounts. So we will buy back our Julys and we will sell forward into September or maybe even December. So you'll see that open interest, which is very large. It's 730 million ounces a couple days ago in the July contract. You'll see that open interest contract sharply and disappear by the end of June. By the time you get into the first delivery date for the July silver contract, most of that open interest will have disappeared and it won't be there. But in the interim, you will see the people, the entities that are short those July contracts, buying back those shorts and then rolling forward into September and December. That can have at times an upward effect on the price. That's exactly what happened in April of 2011, and that's what we got right. You saw the silver price go from $32 to $50 over the course of April 2011, and that, you looked at the data, coin sales were way off. Silver ETFs were actually net sellers of silver over that course of April. The big buying was buying the May contracts and rolling into July. And that caused CPM Group over the course of April to tell our clients, look, price of silver is going from $32 upward sharply because of the May roll. The May roll ends at the end of April, at which point we expect the price of silver to fall back to around $36 an ounce. So don't get excited that this is the beginning of it. We've gotten over $30, so the next stop is $750. Don't get excited. And the price could get up as high as $50 on an intraday basis, but you should expect to not do that. And if you want to take profits, you can take profits. But if you want to be a long-term silver investor, hang on to your silver and buy some puts for July, because we think the price, once we get into the first week of May 2011, we think the price is going to come back off to around 36. We were wrong. It came off to $32. It gave up all of it because all of the upward pressure in April that took the price from 32 to 50 was the roll of the May COMEX contract. Now, it doesn't happen every time you have an active contract, but it did then. And we're looking at the July contract now, and we're saying that could happen again because, again, we have a lot of open interest in the July contract. There are investors who are interested in this thing. It could be that the movement, the roll of the July contract into forward months, which will occur over the course of June, which starts tomorrow, that could have a short-term effect of pushing silver prices up sharply. But it's a sugar high expected to end the first week of July.
Well, Jeff, just when thinking about sugar highs, a lot of people make the case that the moves we've seen in the metals to get silver over 26 and then above 32, and then also in copper to blast up to $5 were on the back of short squeezes. We hear a lot about short squeezes in the marketplace, and then a lot of people are banking on further short squeezes to keep the prices higher. What do you think about the concept of the short squeezes? Are they in the markets? Are we seeing that action in silver and copper?
Well, in the 80s, our lawyers told us not to use the term squeeze, but to talk about congestion in futures contracts. And I think that's a better term because a squeeze suggests that there is a entity consciously trying to squeeze the market. And what you see instead is congestion, which is a lot of open interest that needs to be rolled forward. Our view is that in copper, you probably saw congestion driving the price higher. And yeah, if it went way up, it went way over $5 a pound, and it's down to $4.65. So it's given up like probably 2/3 of its increase that you saw in April. That was with the May contract in copper. We didn't necessarily see that in silver prices. Actually, if you look at the silver price, the big increase in silver prices was after the May contract was already delivered. And during the period of time when the May contracts were being rolled into July, the silver price actually came down from around $29 to around $26.50. So that's an example. I said earlier when I was telling you about the 2011 experience, it doesn't happen with every active contract. In the May contract on COMEX silver, it didn't happen last month. You didn't see upward pressure on the price of silver during the May roll. The upward price move in silver came after the May roll was behind the market. So that tells you that it wasn't just mechanical congestion in the May contract. It was more fundamental investment demand. And as you said, technically or momentum driven demand. After the price found a new floor at the end of April, beginning of May, around $26.50, it moved back up over $27. That was a technical buy point. Then it moved back up over 28 in about 3 or 4 days. That was another technical buy point. And when it broke above $29 in the middle of May, it shot sharply higher. That was pretty much technically driven futures and options demand.
Interesting. All right. Well, thanks, Jeff, for giving us kind of the insights on how you view the COT reports and also these short squeezes. Boy, oh boy, it's had a lot of articles, a lot in the news recently of if these are short squeezes, where the price goes from here, and some pretty extreme calls on silver. You shared your insights, which I do appreciate. I'll post a link to the CPM Group below this interview, and Jeff will chat with you again next month. Thank you very much for your time today.
You're welcome.